116 trades, 71.5% win rate, profit factor 2.7. Second backtest trade statistics, 49 trades, 71.4% win rate, profit factor 2.79. Two independent backtests of the same Renko strategy, 165 trades between them. The first one came in at 71.5% win rate. The second, completely different sample, 71.4%. Now, I didn't run these tests, someone in my community did. And when he sent them to me, I almost didn't make this video because I know 70% win rate claims sound in the trading space. I've spent years on this channel. But the data is the data, and when the same number turns up twice on independent samples, you're past the point of being able to ignore it. So I'm going to walk you through both tests, exactly what they show, what they don't show, and what I think this means for anyone trading the strategy. Three things I want to do in this video. One, I want to show you the actual numbers from both tests. Two, be honest about what backtests can and can't prove because they have real limitations. And I'd rather you heard them from me than from a skeptic in the comments. And three, I'll tell you what I'd expect live performance to look like compared to these numbers because backtests and live trading are not the same thing. If you're new to the channel, the strategy we're talking about is Renko Fibonacci. I trade it on gold and a few other instruments. I teach it through my website, and the whole thing is built around a 2-filter entry system with 3 pending limit orders managed under specific rules. I'll link a video explaining the strategy basics in the description if you want the full breakdown. Now, this video isn't about the strategy itself. It's about the question I get asked more than any other. Does this thing actually work? And what the data says. Okay. Let's get on to the first backtest. So this is the first one. The trader who ran it is one of our community members, and he ran this on his own accord. I didn't ask him to. I didn't pay him. I had no idea he was doing it until he sent me the results. And here's what he did. He used CTrader's market replay mode. That's a feature in the platform. It lets you play through real historical tick data. It takes trades as if you're trading live, and the platform tracks every exit, entry, and P&L is exactly as if it were a live account. So the setup is gold on Renko Fibonacci strategy as I teach it. The brick size and risk per trade following the rules in the strategy. Every valid setup is taken. No skipping ones that looked unpleasant. No cherry picking ones that look good. 2 filters had to pass. The 3-swing rule and the zoom out test. And if both passed, the trade was taken. The results then, 116 trades in total, 83 of them winners, 33 losers, 71.5% win rate. Profit factor is 2.7. That means gross profit was 2.7 times the gross lot. For every dollar lost, the strategy made $2.70. So maximum balance drawdown across the whole test was 4.1%. Maximum equity drawdown, that's the worst the account looked at any individual moment, including during open trades, 6.49%. Longest losing streak, 6 trades in a row. And net profit over the testing window was about 41% on the starting account. Those are the numbers. Now, I want to pause for a second on the most important one, which isn't win rate. It's the longest losing streak. 6 losses in a row with a real 70% plus win rate. That's the variance reality every trader has to make peace with. Even strategies with strong edges produce losing streaks. The maths of probability say that with a 70% win rate, a 6-loss streak could and should happen roughly once in every 1,300 trades on average. The fact it happened inside a 116 trade meant the run included a statistically unlikely pocket, which is good actually. It means the win rate held up despite having a worse than expected losing streak in the sample. So that is test number 1. And I'll just quickly show you the equity curve there of test number 1. So that's 116 trades, 71.5% win, 6 trade maximum losing streak, 4.1% balance drawdown. Honestly, that's impressive. One test of any strategy proves very little. The real question is whether it replicates. So let me show you the second test. Same trader, different window. He ran it again. 49 trades this time, 35 winners, 14 losers. It's a 71.4% win rate. 71.4 versus 71.5 in the first test. Now, I want to be really clear about why this matters. The win rate from the first test by itself could have been a fluke. Markets have favourable periods. Strategies have hot streaks. Samples can flatter the underlying number. One test of anything is just one test, but when you run a strategy on a completely different sample of trades in a different window and the win rate comes back with 0.1% of the first result, that's not luck anymore. That's the strategy's actual performance. So the rest of the numbers from test 2, profit factor 2.79, almost identical to test 1's 2.70. The strategy's making roughly 2.7 to 2.8 times more on its winners than it loses on its losers. Asymmetric payoff consistently. Maximum balance drawdown 3.52%, maximum equity drawdown 5.34%. Both are lower than test 1 because the sample is smaller, fewer chances for a deep drawdown to develop, but still in the same range. The longest losing streak this time 3 trades, shorter than test 1 because, again, smaller sample, statistically expected. Net profit on this window, about 15% on the starting account. So now you've got 2 data points, 165 trades combined, win rate of 71.5 on the first sample, 71.4 on the second. Your profit factor 2.7, then 2.79. Drawdown in the 5 to 6.5% range across both tests, and losing streaks consistent with what probability predicts. That's what evidence looks like when a strategy has a real edge, not perfect numbers. Perfect numbers are the sign of a curve-fitted backtest, and you should always be skeptical of those. Consistent numbers with a reasonable drawdown across independent samples, that is the signature of something that's actually working. Okay, now I want to spend a few minutes on what these tests don't prove, because if I don't say this, the comments will, and I'd rather lead with honesty rather than chasing it. Okay, so 4 real limitations of any backtest, including these. Number 1, backtests don't include real spread widening. When you run market replay feature in CTrader, the platform uses historical tick data, but the spread it applies is typically the average spread at the time. Real trading's different. News releases, low liquidity periods, or fast moves, the spread can blow out 5 or 10 times its average. A trade that exists cleanly in the backtest might exit a few pips worse in live trading. Over hundreds of trades, it does add up. My estimate is real-world spread cost reduces strategy performance by maybe 0.5% to 1% per month, depending on the instrument and the broker. It's not catastrophic, but it is real. Number 2, backtests don't model slippage on entries. It uses pending limit orders, which mostly avoids slippage on entries. Limits either fill at your price or better, but when stops get hit, particularly during fast moves, real fills can be worse than the chart shows. The backtest assumes a clean fill at the stop level. Reality sometimes gives you a couple of pips worse. Same as the spread issue, maybe accounts for another 0.5% of performance drag over time. And number 3, backtests don't include the psychological reality of trading. Now, this is a big one. In a backtest, every valid setup gets taken. In live trading, you skip the setup that comes 20 minutes after a loss because you're not feeling it. You take the setup that looks better than the rules require because you're feeling overconfident after 3 wins. You move your stop loss because you're nervous. You take profit early because you don't trust the move. Every one of those behavioral deviations costs performance. Even disciplined traders deviate from their rules sometimes. Most traders deviate often. This is genuinely the gap between backtests and reality. It's not maths. The maths is fine. It's the human. Number 4, these are pretty short windows. 165 trades is a meaningful sample for win rate, but across both tests, we're looking at maybe a few weeks of trading time total. It's not enough to know how the strategy performs in different market regimes, high volatility regimes, deep bear markets, central bank shocks. The data we have suggests the strategy works in the conditions it was tested on, but it doesn't prove the strategy will work in all conditions. So when I add all of that up, here's what I think a realistic estimate of live performance looks like. Win rate in live trading will probably land somewhere between 60 and 70%. Not 71%, the drop comes from spread, slippage, and the small behavioral deviations even disciplined traders make. Profit factor will probably land closer to 2 rather than 2.7, still strong. A profit factor above 1.5 is considered a quality strategy by most professional standards. 2 is excellent. Drawdown in live trading will probably be deeper than the backtest shows. 6.5% maximum equity drawdown in test 1 is probably more like 8 to 12% in live trading on the same window. Not because the strategy gets worse, but because behavioral slippage compounds during drawdown specifically. That's where people deviate from the rules the most. Now, none of this invalidates the strategy. It just means you should plan around the realistic numbers, not the perfect ones. Okay, so if you take all of that, the strong but imperfect evidence, the backtest to live gap, what does it mean if you're thinking about trading the strategy? Well, three things. One, the edge is real, but the edge isn't enough. The data is now strong enough that I'm comfortable saying the strategy has a genuine statistical edge. That puts it ahead of probably 90% of retail trading approaches, most of which have no demonstrable edge at all. But having an edge isn't the same as making money. You also have to execute it without breaking your own rules, and that is the hard part. The strategy gets you to the starting line, discipline gets you across the finish. Number two, the asymmetry matters more than the win rate. Look at the profit factor, 2.7 in the first test, 2.79 in the second. That tells you the strategy makes about 2.7 times more on its winners than it loses on its losers. The asymmetry is what produces the equity curve, not the win rate alone. A strategy with a 71% win rate and 1 to 0.4 risk to reward would be a losing system. A strategy with a 60% win rate and a 1 to 1.5 risk to reward is a winning system. The Renko Fibonacci strategy is the second type. The win rate is impressive, but it's the payoff structure that does most of the work. 3. The losing streak rule matters more than anything else. 6 losses in a row in test 1. That's the worst the strategy did across 116 trades. If you can't sit through 6 losses without breaking your rules, without changing your risk per trade, without abandoning the strategy, without revenge trading, then the strategy will not work for you, no matter how strong its statistical edge is. That's why I built the discipline halts into the structure. 2 losses in a row, you take a break. 3 losses in a day, stop trading for the day. 5 losses in a week, stop for the week. These aren't suggestions, they're the operational safety system that makes the maths actually work over a long sample. Without them, even a 71% strategy can be made unprofitable by a bad trader. With them, even an average trader has a fighting chance. So, bringing all this together, the Renko Fibonacci strategy has been independently tested by a member of my community across 2 separate samples totaling 165 trades. The win rate came in at 71.5 and 71.4%, almost identical across both runs. Profit factor 2.7 and 2.79, maximum drawdown under 7%, 6 trade losing streaks present in the data, confirming that even a real edge produces real variance. Live performance will be lower than backtest performance. That's true of any strategy. My realistic for live trading is 60 to 70% win rate, profit factor in the 2 range. Drawdowns occasionally reaching 10 to 12% during bad windows. Now, if those numbers hold in live trading, and that's still an if, because no backtest is a guarantee, this is a strategy with a genuine edge, better than most traders will ever access. But here's the thing I want you to take from this video more than the numbers. The reason I made this video isn't to show off the strategy, it's to model what evidence should look like in this space. Most trading content asks you to trust the creator. The creator says they win 80% of trades. The creator shows you one cherry-picked screenshot. The creator promises you can replicate their results. That's not evidence, that's marketing. Evidence is what my guy did in the independent test. Methodology disclosed. Every trade tracked, wins and losses, drawdowns visible, done twice, numbers reported honestly, including the bad ones. Now, before you trust any trading strategy, mine or anyone else's, that's what you should be asking for. Show me the trade log, show me the drawdowns, show me the losing streaks, show me it twice on different windows. Show me what your live performance looks like compared to your backtest. If a strategy can't survive that level of scrutiny, it's not a strategy, it's a story. The Renko Fibonacci strategy has now survived that scrutiny twice. That doesn't make it a guarantee, but it does make it real evidence, and real evidence is what you should be making decisions on. A few things if this video was useful. If you want to see the strategy applied daily on real charts, our free Telegram has one Renko setup screenshot every morning. Link is in the description. No sign up, no upsell, just the setup. If you want the full Renko Fibonacci framework, the entry filters, the order management, the discipline halts, the trade journal, the CBOT that handles the position sizing automatically, that's what I'm going to teach in a full mentorship over at renkogold.com. There's also an indicator-only option tier for people who just want the tools without the training. It's linked in the description. And also there's a free Renko checklist with the basics of the entry rules. That's also there as well. So on the next video, I'm going to use the numbers from these backtests to answer the question I get asked more than any other. Can you actually grow £50 into £5,000 trading Renko? I'm going to do the maths honestly, including what the failure rate looks like at high risk levels, because the people who don't show you the failure rate are the people you should be running from. I'll see you later for that video. Thanks for watching. Bye for now.